Cerulli, General Manager here at Penske Honda Chula Vista. Today's talking point is leasing versus purchasing or financing. Have you ever heard that expression, lease what depreciates and buy what appreciates? That saying was made famous some 75 years ago by oil tycoon John Paul Getty. What that saying is to lease a depreciating asset and to purchase an appreciating asset. There is no greater depreciating asset than an automobile. Your car's value decreases 20 to 30% by the end of the first year. In fact, the minute you drive that brand new shiny vehicle off the lot, you've already lost 20%. Think about that for a minute. If you bought a new vehicle for let's say $25,000, you'll lose $5,000 in the first 60 seconds of ownership. As you continue into your ownership cycle, your vehicle will depreciate in ranges of 15 to 18% per year. According to recent data from Black Book, which tracks used car pricing, as a rule of thumb in 5 years, cars lose 60% or more of their initial value. On the other hand, an appreciable asset is anything that appreciates in value, such as land, real estate, and stocks. So what are the advantages of leasing? Here are just a few without getting too deep into the weeds with tax benefits and business write-offs. The payments, interest rates, tax, upkeep, and maintenance are all tax deductible. You must, however, if you are a business owner, show proof that the vehicle is being used for those business purposes at least 50% of the time. But enough with business ownership. You can lease a more expensive vehicle with more features and even more safety functions. Your monthly payment when leasing is considerably lower than financing. Your initial out-of-pocket costs are also considerably lower. You can buy it at a guaranteed future value at the end of the lease, which is more commonly known as the vehicle's residual value. You'll actually know on day one what that residual value is at the end of those 3 years. There have even been instances with leases where people will trade them in because it just so happens that they have equity. And the other thing that a lot of people don't realize today is that the more miles that you drive per year, the better off you are to lease a vehicle, because you're only paying 50% of what that mileage cost would be by billing that mileage in up front. So again, let me repeat that one more time. You know, a lot of people are under the misconception that the more miles that you drive per year, the worse it is to lease. Well, that is not true. That is absolutely not the case. In fact, when you are driving more than 15,000 miles per year, let's say even upwards of 20 and 30,000 miles per year, it actually makes more sense to lease than it does to finance a vehicle. Because what happens with the lease is, yes, you will pay more per month in your monthly payment for those additional miles, but by building those miles in up front, you're only paying 10 cents per mile compared to paying 20 and in some cases 30, 40, and 50% depending on the type of vehicle that you have, should you turn that vehicle in at the end of the lease and not having had built those additional miles in up front. So again, let me repeat real quick here, because again, a lot of people just don't understand this. The more miles that you drive per year, the better it is for you to lease, because you can build those miles in at the initial onset of that lease for, in most cases, 50% less than if you were to pay for them at the end of that lease. So again, the more miles you drive, the better it is for you to lease a vehicle. Absolutely, hands down, no question about it. The other thing that's really great about leasing a vehicle is that you're driving that vehicle typically in the first 36 months, which really are the most trouble-free years of that vehicle's life. And the other thing that gives you huge peace of mind is that when you lease a vehicle, in most cases 36 months, you're always going to be covered under that vehicle manufacturer's warranty. So your out-of-pocket costs for, repairs that could go wrong really are going to be absorbed by the manufacturer, because in most cases a vehicle today has a 3-year, 36,000-mile bumper-to-bumper warranty. So again, there's no better protection than knowing that you're covered during that lease period by the vehicle's original factory warranty. So again, great stuff. So many times I see customers come in the dealership and I see them leave the dealership, with a newer used vehicle, and I only to find out that they signed a 60-month, a 72-month loan, and even in some cases an 84-month loan, all with good intent, and all of those guests signed up for those long-term finance contracts because they were trying to lower their monthly payment. With these long-term finance contracts is, let's say your wants and needs change. Let's say you had a new addition to the family. You needed to trade in that compact vehicle for, let's say, a crossover type of vehicle, or for that matter, an SUV. And what happens is, when you are in one of these long-term finance contracts and you try to trade that vehicle in well ahead of its maturity date, more than often you're going to be in a position where you find yourself being upside down. You've all heard of that saying before. You've either been in that position at one point in time in your life, or you certainly know family and friends who have. And it's just really not a good position to be in when you're upside down with a vehicle. And let me just kind of explain to you what that means. Being upside down on a vehicle simply means that the trade-in value, which we call the actual cash value of the vehicle that you're trading in, is worth considerably less than what your payoff is on your finance contract. As an example, if somebody trades a vehicle in, and let's say we give them $15,000 of trade value, and let's say their loan value is, let's say, $22,000. Well, the difference between $15,000 and $22,000 is $7,000. Now, the customer at that point has a couple of different choices. First choice to address that inequity would be to write a check for $7,000. But to be able to write a check today for $7,000 is not the easiest thing in the world to do. So the other option that you have would be to take that $7,000 and roll that into your new loan. Well, that's a lot easier said than done too, because with these new vehicles today, whether it be new or used, vehicles have a loan-to-value ratio that banks will lend money against. So just rolling $7,000 into a new car loan, really, all the moon, the stars, and everything has to be lined up in order to do so. The vehicle that you're looking at has to have a good loan-to-value ratio, or else it's just simply not going to work. I try to encourage people to at least look at a lease, in this particular situation, a 36-month lease, where their payments will be lower. They're not going to have to come up with, as considerable a down payment to get within those loan-to-value ratios that the banks and credit unions are lending money at today. So, I get it. Some people just simply are hung up on the fact that, they want to own the vehicle, and that's a whole nother issue too. When I bring up the option of leasing, one of the first objections that a customer will always say or bring up is that, well, I don't own it. And I could never really understand that when they say that, because even if they were to finance the vehicle, well, guess what? You don't own it either. The bank owns it. It's a situation where it's an education process, and I hope that through this series of videos that I'm going to be doing, I hope I can bring some education and some awareness to some other options that you have out there in the marketplace when it comes to purchasing a new or used vehicle. Another thing too is the longer that you take out a loan for your vehicle, again, 60, 72 months, 84 months, what ends up happening is your factory warranty ends. If you're in a 72-month loan and you have a powertrain warranty, or for that matter, you have a bumper-to-bumper warranty that's 3 years, 36,000 miles, Well, come 3 years, 36,000 miles, whichever comes first, that bumper-to-bumper protection has expired. Most manufacturers will also offer a powertrain warranty. In most cases, your powertrain warranty could be 4 or 5 years, could be as many as 50 or 60,000 miles. And that's going to be on the powertrain or the drivetrain of the vehicle. But again, that too will expire well ahead of a long-term finance. So again, when your factory warranty lapses or terminates well before your finance contract matures, you're exposing yourself to more repairs and more maintenance, which are just pure out-of-pocket, additional costs. So not only are you making a monthly car payment, you're also, having to come up with out-of-pocket costs that are directly related to that vehicle, aging, 60, 72, and even 84 months. So in short, financing a vehicle, although it is an option for you, it may not be the best way to go. Taking out long-term loans and trading them early can get you in a position where you're going to be upside down. We talked about that. Also, the longer the term, you're going to probably pay a little bit slightly higher interest rate, which is just going to compound more finance charges. So again, I would really encourage you to look at leasing. I would actually be more than happy to sit down with you and to further discuss, some leasing options. And even if we have to, I can even do a side-by-side comparison for you of a lease versus a purchase. And in most cases, the lease is going to be less, even if you choose to buy that vehicle at the end of the lease. I'm even going to give you my cell phone number, and that's 619-348-7648. Feel free to give me a call, reach out to me, and I'll answer any questions that you have when it comes to other options related to buying a new or used vehicle. I hope you've enjoyed this little series today on leasing, and I hope I've shed some light on some more options for you. Thank you.